All right, find a seat, everyone. Settle in. For today's explainer, we're basically going to treat the next few minutes as your Finance 101 freshman syllabus. I'll be playing the role of your finance professor today. We're going to draw directly from the incredible insights of Duke University's Cam Harvey to truly demystify investing and show you how to build real, lasting wealth. Look, we're stripping away all that confusing Wall Street jargon. We're just going to focus on the core, undeniable truths of the market. So grab a notebook, get comfortable, and let's start building your financial foundation. Here's a quick look at the syllabus for today's explainer. We'll kick things off with the foundations of a beginner portfolio, then structuring your 90-10 portfolio. Next, dangerous investor behavioral traps, followed by retail versus institutional realities. And finally, reading valuations and AI trends. Let's dive right in.
All right, Section 1, Foundations of a Beginner Portfolio.
Our very first foundational term is the index fund. Now, this is absolutely required reading for any beginner, purely because it provides the absolute easiest, most stress-free baseline. You know, picking individual stocks successfully, that takes a massive amount of effort, time, and access to data that, frankly, most of us just don't have. So, instead of hunting for that one needle in a giant haystack, an index fund basically lets you buy the entire haystack. It gives you broad market diversification at a really low cost, letting you completely bypass the anxiety of trying to pick a single winning company.
Next up, we have the PE ratio, or the price-to-earnings ratio. Now, as a new student of the market, you're probably wondering, why on earth does a PE ratio matter to me? Well, think of it as your ultimate measuring stick for value. It simply takes a stock's current price and divides it by its earnings per share. If a stock, or honestly even the entire market, has a very high PE compared to its historical average, it is generally considered expensive. It's overpriced. And history tells us that a lofty PE usually signals a really high probability of a downward correction as the price eventually comes back down to reality. It's a totally vital indicator to help stop you from buying right at the absolute peak.
Our third definition is stock options. This is a great illustration of how huge companies actually keep their best talent. An option gives an employee the right to buy company stock in the future, but at a firmly set price. Okay, imagine a stock is trading at $90 today, and you, as an employee, are given the option to buy it in 5 years for $400. I know, that sounds completely crazy right now. But what if the company explodes and the stock hits $1,000 in those 5 years? Well, you get to buy it for $400, immediately sell it for $1,000, and you pocket a massive $600 profit for every single share. It creates these absolutely incredible paydays, and it perfectly aligns the employee's incentives with the overall success of the company.
Moving right along to Section 2, structuring your 90-10 portfolio.
Okay, so many beginner investors make this huge mistake of only buying domestic stocks, just sticking to what they know. But you absolutely need to write this shocking disparity down in your notes. The United States represents only about 15% of total world GDP. Yet, it makes up a massive 50% of the entire global stock market's value. Because the US is just so heavily dominant in market cap, but actually relatively smaller in real global economic output, splitting your investments 50-50 between US and international stocks is highly recommended. That's what gives your portfolio the true global diversification you need for long-term stability.
So how do we actually piece all of this together? Well, here is my ideal professor's starter portfolio. You want to keep the vast majority. We're talking 90% safe, frankly kind of boring, and highly diversified. Use those global index funds we just talked about, maybe mix in some money market funds to earn maximum yield. But you should hold back about 5 to 10% of your cash to actively research and pick individual stocks. Why? Well, mostly because it's fun. But more importantly, managing that small 10% slice forces you to actually learn. You learn how to track records, how to collect information, and how to genuinely understand valuations without risking your entire life savings.
So, what is your ultimate grade for all this highly disciplined structuring? 7%. That right there is the historical long-term average return of the S&P 500. Now let's break that down just a bit. If we account for the Federal Reserve's target inflation rate, which is typically around 2%, you are looking at a real, tangible return of about 5%. But listen closely because there is a massive catch here. This return is absolutely not guaranteed unless you are perfectly willing to stay in the market and ride out the nasty drawdowns. You literally only get that 7% if you can conquer your own panic when things look grim.
Which leads us nicely into Section 3, Dangerous Investor Behavioral Traps.
If there is only one lesson you take away from this entire class, please let it be avoiding this trap: buying high and selling low. Look, logically we all know we are supposed to buy low,
But human psychology is just incredibly persuasive. Imagine a stock starts shooting up in value. Everyone is talking about it. It attains this lofty, highly expensive PSE valuation, and that is exactly when people get massive FOMO and decide to buy in. You are literally buying at the exact moment everyone else is pausing to take a second look. So when the inevitable downward correction happens, you panic, you sell at a huge loss, and you completely destroy your wealth.
And if you want to see a real-time, cautionary case study in dangerous behavior, just look at meme coins. Meme coins are these cryptocurrencies with literally zero fundamental value. They aren't backed by a business or revenue or anything. They act way more like digital trading cards. And notice this absolutely staggering multiplier. Meme coins are 20 to 100 times more volatile than the traditional stock market. Let that sink in. There is absolutely no evidence that a portfolio of meme coins actually makes money over time. It is pure, unadulterated gambling. If you decide to put money here, you must be 100% prepared to lose every single cent of it.
All right, let's shift gears. Section 4, Retail versus Institutional Realities.
If you have ever, even for a second, thought about quitting your job and becoming a day trader, you really need to understand the competition you are up against. Day trading is fiercely difficult because you are stepping into a boxing ring with absolute heavyweights, institutional hedge funds and high-frequency traders. These institutions have massive computing resources, incredibly fast data feeds, and literal armies of engineers trained in AI and machine learning. Plus, hedge funds utilize both long and short strategies. Here's what that means. Say the overall market drops by 20%. A hedge fund might lose 20% on the stocks they bought, sure, but they might make 30% on the stocks they shorted or bet against, so they walk away with an overall 10% profit during a market crash. The average emotional day trader sitting at home on a laptop simply cannot compete with that kind of institutional-grade scale.
It is also absolutely vital to understand the legal realities of how you gather information. Say you find a hot stop tip on a TV show, in an internet forum, or via a YouTube explainer. That is entirely legal. That's public information. Now, it might be terrible advice, but it's legal. However, if you get a hot tip from a bunny about unreleased clinical trial results or some secret upcoming corporate merger, that is insider trading. Using non-public information to buy or sell a stock is deeply unethical, it's incredibly unfair, and it is highly, highly illegal. You have to know the boundary and stay firmly on the public side of that line.
Finally, let's wrap up with Section 5, Reading Valuations and AI Trends.
A lot of people right now are rightfully asking if AI today is just a repeat of the 1999 dot-com tech bubble. But the sources point out some really profound differences here. In the 90s, the internet was primarily just a tool to collect information, and investors were blindly throwing money at the future earnings of companies that weren't actually growing yet. Today is an entirely different ballgame. AI doesn't just collect info, it actively solves incredibly complex problems and boosts productivity across literally every single sector. And modern tech leaders are already massively profitable, which brings us to this fascinating concept of self-disruption. Companies today are perfectly willing to destroy their own profitable business lines just to advance. Just look at Tesla. Most people think of them as a car company, but their heavy investments in self-disruption effectively make them a robotics and AI company now. The fundamental economics today are just vastly stronger than they were in 1999.
So for that 10% of your portfolio that we decided to dedicate to picking individual stocks, here is your actual practical homework. Step 1, review the official SEC 10K filings. Step 2, go out and read all the available analyst coverage you can find. But Step 3 is your secret weapon. You need to listen to the unscripted quarterly earnings calls. See, a 10K document is carefully sanitized by teams of corporate lawyers. But during the unscripted Q&A portion of an earnings call, that is where you hear the raw, unvarnished truth from executives. And finally, Step 4. Exercise restraint. Do not buy when the hype is at its peak. Wait patiently for a value correction, and only then enter your position.
And just like that, we have reached the end of our syllabus. We've covered the immense power of index funds, the institutional giants you are competing against, the severe dangers of emotional trading, and the precise mechanics of a disciplined 90-10 portfolio. So the whole thing boils down to this final exam question. Are you going to let FOMO drive you to invest like a gambler chasing meme coins? Or will you use the patience, the structure, and the emotional discipline of a finance professor? The choice you make right now dictates your entire financial future. Thank you so much for joining this explainer. Class dismissed, and we will see you next time.